Eldridge's Chicago office, their capital management group, asked this question in a recent Superday interview. A bond has a 3% coupon, 5% yield, and $100 par value. Is it trading at a premium, par, or on a discount? Why? This is one of the most fundamental fixed income questions you can get, and it comes up constantly in interviews, especially at firms like Eldridge that do a ton of credit work. And honestly, a lot of candidates fumble this one. Not because it's hard, but because they memorize the rule without understanding why it works that way. So here's what the interviewers actually tested. First, do you understand the basic mechanics of bond pricing? What coupon rate, yield, and par value actually mean? Second, can you explain the inverse relationship between price and yield in a way that actually makes intuitive sense? And third, do you have a conceptual understanding of how bonds trade in the real world, not just textbook definitions? By the end of this video, you'll understand exactly how to think about bond pricing, why the coupon-yield relationship drives whether a bond trades at a premium or a discount, and how to deliver a concise, confident answer that shows you actually get it. Now, if you're new here, I'm Max Adams. I'm the head coach at Wall Street Mastermind. I started my career in investment banking at Lazard, then Catalyst Partners, which are two of the most selective advisory boutiques on Wall Street. And then I moved into tech PE and also completed an MBA at Stanford while doing a joint degree at Harvard. Now, during that time, Wall Street Mastermind has helped over 2,100 students break into top finance roles. And our coaching team includes former global heads of recruiting from JP Morgan, Bank of America, Credit Suisse, and more. So you're in good hands here. Let's get into it. But before we answer the question itself, let's make sure that we're very, very clear on the three key terms. Par value. This is the face value of the bond. So in this case, $100. That's what the issuer promises to pay back at maturity. Second, the coupon rate. This is the annual interest payment expressed as a percentage of par. So a 3% coupon on a 100 par bond means that the bondholder receives 3 per year. And the yield, especially the yield to maturity, is the total return that the market is currently demanding from this bond. Factors in the coupon payments, the price you pay today, and the par value you receive at maturity. So think of yield as the market's required rate of return. Now here's the core concept you need to internalize. The coupon rate is fixed. When the bond was issued, the issuer said, I'm going to pay you 3% per year, and that never changes. But market conditions change constantly. Interest rates move, credit risk changes, investor required returns shift, and the yield reflects what the market demands right now. So the question becomes, if the market demands 5%, but the bond only pays a 3% coupon, how does the math work? The answer is that the bond's price has to adjust. Since the coupon is locked in at 3%, the only way for an investor to achieve a 5% effective return is if they buy the bond for less than $100. And that's why the bond trades at a discount. So think about it this way. Imagine you're an investor and you have two options. Option A is a new bond being issued today that pays 5%, matching the current market rate. And option B is the existing bond that only pays 3%. Why would you pay the same price for option B when it gives you less income every year? You wouldn't. You'd demand a lower price, a discount, to compensate for the lower coupon payments that you're receiving. That discount is exactly enough so that your total return, combining the lower coupon payments with the capital gain from buying below par, equals the 5% yield. Let me give you a simple numerical example to make this concrete. Say this is a 1-year bond for simplicity. It pays a $3 coupon, returns $100. If you need a 5% return, what's the most that you'd pay today? Well, you'd pay the present value of 103, discount at 5%. And so that's 103 divided by 1.05, which is roughly $98. And so you'd pay 98.10, which is below par at a discount. So you've got the $3 coupon plus 190, and so you get about $490 total return. And on a 98.1 investment, that's actually right around 5%. Now let's quickly cover the two other scenarios so you have the complete picture. If the coupon rate equals the yield, the bond trades at par. Makes sense. You're getting paid what the market demands, so there's no reason for the price to change. And if the coupon rate exceeds the yield, let's say that you have a 7% coupon and a 5% yield environment, the bond trades at a premium above $100. And so investors are going to bid up the price because it's paying more than what the market requires. So why does any of this matter for investment banking? Well, bond pricing is fundamental to many things that you're going to work on. In leverage finance, you're structuring debt for acquisitions, and you're going to need to understand whether bonds will price at par, at a discount, or at a premium based on market conditions. In LBOs, you're going to need to understand the pricing of the debt, and it's going to directly impact your returns. And you're going to need to understand in restructuring whether distressed debt is going to trade at a discount and understand why that's essential. And so to a firm like Eldridge that's heavily involved in credit investing and capital management, they want to know that you can think about fixed income intuitively, not just recite formulas. So now let me give you a sample answer that you could use in the interview. This bond is trading at a discount, below its $100 par value, and the reason is straightforward. The coupon rate of 3% is lower than the yield to maturity of 5%. The coupon is fixed. It's set when the bond was issued, but the yield reflects why the market currently demands more. Since the bond only pays $3 per year in coupon income, but the market requires a 5% return, the bond's price has to drop below par. And that price discount effectively gives the investor an additional return on top of the coupon through the capital gain that they're going to realize when the bond matures at par. And so their total return will equal the 5% yield. If the coupon equaled the yield, the bond would trade at par, and if it exceeded, then it would trade at a premium. Okay, that answer is clean, it's structured, it shows that you understand why, not just what. And that's exactly what Eldridge and other firms like that are looking for. Now, if this video is helpful, hit like and subscribe and drop a comment on what topic you want me to cover next. And if you're serious about your preparation and you want one-on-one coaching from the people who've actually done this at the top banks, check the link in the description. I'll see you in the next video.